Just to update those that have dialed in, we're going to give a minute or two to allow those that are still dialing in to arrive, and then we'll get started. Okay, we're 2 minutes after the hour, so we'll go ahead and get started. Welcome everyone, and thank you for joining us for today's webinar, Directors and Officers Insurance Insights 2025. In an era where the global business landscape is more interconnected and complex than ever, directors and officers face unprecedented challenges. This session is designed to explore the critical risks and opportunities shaping the future of governance and corporate leadership. Next slide, please. So I'd like to introduce our panelists today. We have Jarrod Schlesinger, Global Head of Financial Lines and Cyber, Jacina de Rosa, myself, Global Underwriting Head of Multinational-Financial Lines and Cyber, Hannah Tindal, Head of Management Liability Commercial Regional Unit London, and Dan Holloway, Global Head of Management Liability Commercial. Today, we'll begin with the big picture, examining exposures that transcend borders and the increasing interconnectedness of risk in a globalized world. From there, we'll delve into the implications of rising insolvencies, highlighting how economic pressures are reshaping corporate stability. Next, we'll tackle the rapidly expanding influence of litigation funding, discussing its role in escalating claims and changing the litigation landscape. We'll also explore the transformative potential and pitfalls of artificial intelligence, focusing on its risks for governance, privacy, and accountability. And finally, we'll wrap up with a look at insurance market dynamics, offering insights into how shifting trends impact coverage, pricing, and risk management strategies. And of course, we'll close with a dedicated Q&A session to address your thoughts and questions. Next slide, please. To get started, while we're presenting, please post your questions directly in WebEx using the window on the right-hand side, or scan the QR code shown on the screen, or post them online at slido.com. You can join as a participant and enter the passcode Allianz. Okay, let's get started with the big picture, exposures without borders. The next two slides will outline the increasing risks and challenges directors and officers face as global regulatory scrutiny grows, focusing on 5 key emerging issues. The first of which is ESG liability risks. Environmental, social, and governance concerns are now central to corporate responsibility. Directors and officers are increasingly held accountable for their company's ESG impact. A notable trend is the rise of greenwashing claims, where companies are accused of overstating their environmental or social credentials to attract customers, gain business, or enhance their public image. This shift poses significant liability challenges as stakeholders demand greater transparency and authenticity. A significant example involves DWS Group, a Deutsche Bank subsidiary. In 2023, DWS Group paid a $25 million settlement to the U.S. SEC for charges for overstating its ESG investment processes. Also, in November of just this year, 11 Republican-led U.S. states sued BlackRock, Vanguard, and State Street, alleging antitrust violations for coordinating efforts to reduce coal production and emissions, which they claim harmed competition and raised electricity costs. These cases highlight the legal risks of ESG initiatives, where companies may face lawsuits for both overstating sustainability efforts and implementing strategies seen as harmful to traditional industries. Also, we'll take a look at privacy-related risks. This has become a critical area of concern in D&O liability, driven by the escalation of privacy-related lawsuits. High-profile cases, like Google's $350 million settlement this year over a data breach involving its Google Plus platform, highlight the financial and reputational risks companies face. As privacy becomes a key focus of regulatory frameworks and litigation, the stakes for directors and officers in ensuring compliance and safeguarding data have never been higher. In May 2023, Meta was fined €1.2 billion by the Irish Data Protection Authority, the largest GDPR fine to date, for inappropriately transferring personal data to the U.S. for nearly 3 years. Subsequently, Meta was also ordered to align its data transfers with GDPR regulations. Also in July of this year, Meta agreed to a $1.4 billion settlement with Texas over allegations of unauthorized use of users' biometric data. These examples show how crucial it is for leaders to prioritize data privacy. Failing to protect user data or follow regulations can lead to massive fines, lawsuits, and damage to a company's reputation. On to the next slide. Now let's take a look at geopolitical challenges. Global tensions, such as the war in Ukraine, Middle East conflicts, and strained U.S.-China relations, create far-reaching impacts like supply chain disruptions, business interruptions, and regulatory scrutiny. A notable example is the 2023 securities class action lawsuit against Baxter International, Inc., where executives were accused of failing to disclose significant supply chain challenges. This lack of transparency allegedly led to increased costs, reduced earnings, and investor losses, illustrating the critical importance of clear communication with stakeholders about operational risks. We also see a trend in non-compliance with sanctions and misjudging impacts. Companies can face severe penalties for failing to comply with sanctions. In 2023, Seagate Technology Holdings faced a $300 million penalty from the U.S. Department of Commerce for selling hard disk drives to Huawei Technologies, a firm under U.S. trade restrictions. In addition, shareholders filed a securities class action lawsuit claiming executives failed to disclose these violations, resulting in financial losses. This case highlights the risks directors and officers face in navigating complex geopolitical regulations. And finally, artificial intelligence exposures. Jarrod will be covering this in more depth in the coming slides, but it is important to highlight here that as corporations integrate AI to remain competitive, they face significant cross-border risks because AI technologies often operate across jurisdictions, exposing directors and officers to liabilities under varying legal frameworks. This intensifies the need for robust oversight and governance in adopting and deploying AI solutions. Next slide. To conclude, I want to highlight some of our key takeaways for D&Os navigating today's challenging landscape across borders. First, in today's rapidly changing world, D&Os must stay informed and adapt to avoid legal and financial risks. D&Os need to update their knowledge around geopolitical and regulatory changes more frequently than before. A once-a-year review is no longer sufficient in the volatile era businesses are now operating in. Second, as companies innovate and adopt AI, D&Os need strong processes to handle privacy, confidentiality, and compliance issues while reducing liability risks. And to bring it home, with stricter regulations across countries, multinational companies face more complex compliance challenges, making customized insurance programs essential to manage risks and meet legal requirements across borders. Tailored local policies can help address region-specific risks, providing an additional layer of protection and ensuring compliance with local legal requirements. Now I'll pass it to Hannah to cover rising insolvencies.
Thank you, Jacinda. There's certainly no shortage of complex issues for directors and officers to be considering and preparing for in the year ahead. I think, another matter that's really top of mind is the faster than expected acceleration in insolvencies. We saw this in 2024 with global insolvency rates up 11%. These rates are expected to increase an additional 2% in 2025 before seeing some stabilization. In addition to the persistent geopolitical uncertainty and the challenging financial conditions, there's still subdued global demand for goods and services. There is also a remaining backlog of insolvencies as companies are no longer shielded by the support measures that were put into place during the pandemic and also the energy crisis. This could result in more insolvencies could result in more insolvency-related claims against directors and other connected parties for breaches of insolvency legislation and their duties. Next slide, please. As you can see from this slide, business insolvencies are not anticipated to stabilize until 2026, and even then are expected to remain at very high levels. 2/3 of countries are set to reach the year end with a number of insolvencies above pre-pandemic levels, compared to 1 out of 2 countries in 2023. Notably, the US and Germany are expected to see plus 12% and 4% respectively, while France and the UK are likely to moderate but are already at significantly high levels. In China, we expect to see a rise from lower levels, but seeing those increase in 2025 and 2026. Insolvency at these levels can materially impact employment figures into the coming year, with an estimated 1.6 million jobs at risk in Europe and North America alone. These insolvencies also have potential to have a knock-on effect down the supply chain, which is also concerning. And while there may be changes to monetary policies, the anticipated lower interest rates are no guarantee for improvement and may only provide moderate relief for companies dealing with higher debt loads. Next slide, please. So where can that lead us? Insolvency-related claims are a large source of claims against directors and officers across jurisdictions, and the risk of claims has increased as these insolvencies continue to climb. Lenders can bring claims against D&Os to recover funds. There is exposure from shareholders, as they can allege a breach of fiduciary duty, such as failure to prepare adequately for or disclose the challenges a business is facing. There is also a higher risk of fraudulent, dishonest, or wrongful actions during this time. These could all lead to more action against D&Os for breaches of insolvency legislation and their duties to the company, in addition to disqualification proceedings and orders of compensation. Additionally, companies that may be looking to reduce headcount during this time could face employment practices liability exposures if not handled properly. Next slide, please. What will distinguish one company from another is the due diligence that they have exercised as they strategize to prepare and account for these challenges. Taking the steps to manage as well as their communication and disclosures will be important. One area that we see particularly challenged are small to mid-sized businesses that are, not as resilient to these economic hardships as potentially some of the larger companies. particularly in industries in consumer discretionary businesses, such as restaurants, clothing, car dealership industries, basically all industries of non-essential goods, where we are seeing the most impact currently. Also, those companies that are seeking to refinance loans or get new loans may only receive moderate to short-term relief, so potentially not improving the overall picture ahead. But while there are these pressures for businesses, D&O can play an important part in providing protection for companies and individuals. With lawsuit costs rising, the personal impact can be significant. The lack of insurance protection could be material. Engaging with brokers, underwriters, and claims teams early can provide clearer understanding of the coverage intent before a claim issue occurs, and can help risk manage for these companies. With the increasing complex landscape, D&O has become a comprehensive risk management strategy for all sizes of businesses. So understanding what your options are is very important. I hope you found this section informative. As Jacinda mentioned, we will be taking questions or happy to answer any additional questions you have within the Q&A. So please pop those in there for us. But for now, I'm going to pass you over to Dan Holloway, who'll be walking you through what's happening in litigation funding.
Thanks, Hannah. Very interesting. And let's hope that the rise in insolvencies isn't too severe in the short term before the predicted improvement begins. But I think we can all agree that's certainly a space to watch in the mid-corp universe, both for the companies themselves and the insurers. Now, I'm going to shift direction a little bit here as I walk us through the rising impacts of litigation funding. It certainly has its pros and cons for plaintiffs, defendants, and insurers. And it certainly doesn't seem to be isolated an issue from a geographic aspect. But firstly, let's just set out what litigation funding is. Litigation funding is a financial agreement in which a third-party funder provides financial resources to a plaintiff to help them cover the costs associated with a legal case. Third-party litigation funding provides financial resources for plaintiffs who may not have the financial means to pursue a legal claim on their own. It's often perceived to level the playing field, allowing individuals or smaller entities to pursue claims against larger, more resourceful opponents. We could move to the next slide, please. So now that we've summarised what third-party litigation funding is, we'll take a look at the global landscape of the litigation funding industry. Globally, litigation funding is expected to grow on average of about 8.7% compound annual growth rate between 2020 and 2028. And all corners of the world have active third-party litigation funding active in their justice system, ranging from Australia through Europe and into the US, where their markets appear to be quite mature. Historically, there's been a distinct lack of regulatory oversight in third-party litigation funding, but as we see the industry grow, we'll see more attention from regulators, I'm sure, on a global basis. Take the UK, for example. Initially, third-party funding was prohibited in the UK to protect against adverse effects of abusive litigation and corruption of the litigation process. However, in the late 90s and from the start of the 2000s, it was accepted as a funding method to promote access to justice. Now, here in 2024, we've recently seen the Civil Justice Council's review into litigation funding. This resulted in an interim report and a consultation that was published last month, and the final report being scheduled for summer 2025. The final report will consider, amongst other matters, the current position concerning self-regulation and to whether and how third-party funding should be regulated externally. In the US, the US Chamber of Commerce Institute for Legal Reform argued in a recent report that third-party litigation funding has become a dominant feature of the civil justice system in the United States and abroad, and operates largely in secret without any meaningful oversight. So I think we can see that the regulators are starting to really sort of cast an eye over this industry, and it would be naive to expect that they don't start ramping up some kind of activity of their own. So it's certainly a space to watch, and I think 2025 will be an interesting year in that respect. What we may see mandatory disclosure requirements. We may see cap on returns and limit the percentage of the proceeds that funders can claim. We'll see some licensing and oversight, I'm sure, establishing a regulatory body to oversee funders. And I would be surprised if there's not some conflict resolution mechanism that will help resolve disputes between funders, litigants, and attorneys. If we can jump to the next slide, please. So just before I finish up, we see class actions on the rise. Investor class actions are common in the US and Australia, I think, as D&O underwriters, and in the D&O market, we know that. But the rise of consumer class actions across Europe is really going to give rise to a possible potential for investor class actions. There's certainly an increase in exposure for companies in the public field, and it's also an opportunity for the third-party litigation funders. Now, as I mentioned earlier, the benefits of third-party litigation funding are certainly apparent for the plaintiffs that do not have the financial means to bring a claim, and it helps in redressing the balance. It can only help combat the large organisations with those deep pockets. However, there are also adverse impacts. The exposure to the directors and officers of the defendants, for example. It's likely to boost the number of investor claims, increase the severity of them, and result in higher settlements or damages. With funders taking a bigger slice of the cake, larger settlements will undoubtedly come, and that will lead to higher insurance costs likely. When you have a third-party litigation funder involved in a case with a vested interest in the outcome, it is most likely that the claims will not end in an early settlement. They'll become more complex due to the inclusion of sophisticated experts that the third-party litigation funder can afford to hire. Now, the EU is a particularly interesting jurisdiction to keep an eye on. Following the implementation of the Representative Actions Directive, that aims to facilitate collective proceedings for consumers, it would be logical to assume that the number of class actions again could rise. And guess what? We have to assume that third-party litigation funders will be poised to act. Now, I hope you found that informative, and please do scan the QR code on the side, and we'll look to answer your questions at the end. I'm now going to pass you over to Jarrod, who will discuss the risks around artificial intelligence.
Well, thank you, Dan. That was really a very interesting discussion of litigation funding and something we're definitely watching here. There's hugely the potential for there to be impact on the D&O world and what we're doing. So thanks for that, Dan. And thanks to the team so far, doing a great job. I just going to talk about artificial intelligence a little bit and give you a sense of what's going on in that space and how it relates to the D&O world. Artificial intelligence, also known as AI. This is a topic that's received a lot of press over the last couple of years and has many implications for businesses and their D&O insurance. That's because AI is a potential game changer for businesses with legitimate applications we've barely scratched the surface of. AI is real and it's probably here to stay, but I would say it's in its very early stages and presents many unknowns, which will always be an issue for D&O underwriters and carriers. As this topic is so new and evolving so quickly, companies need to make this a key focus and adapt to mitigate the exposures this new technology raises around disclosure, regulation, shareholder scrutiny, and litigation. AI must be subject to the same level of control as any other public statements that a company makes. You can't just ignore AI and do nothing with it. The same or higher level of potential fines and penalties, litigation, and reputational damage are possible as with other corporate disclosures. As such, careful thought and consideration needs to be put into what is going to be disclosed, the timing of such disclosure, and the audience for the disclosure as well. Seeking input from internal and external experts, whether it's lawyers, accountants, consultants, etc., is definitely well advised and something all companies should be considering. Point out the potential pitfalls. AI-related litigation is increasing, for sure. 38 AI-related securities class action lawsuits were filed between March of 2020 and October of 2024, including at least 13 so far in 2024. Next slide. So what are some of the key concerns with AI today? Well, a critical consideration is the data on which AI is trained, the inputs, what you put into the AI. The real reason for it being a concern is it can result in biased or inaccurate output. Basically, garbage in, garbage out, sort of the same thing you talk about in so many other data entry type things. Some results are completely fabricated. So if you have bad data going in, you can have what's known as a hallucination. And an example of a hallucination was in the US, there was a law firm that were using AI to help them draft briefs, legal briefs, court briefs. And cases were cited in that brief that were completely fabricated by AI. So that's a great example of hallucination. So these were cases that just didn't even exist, that were fully created by AI. So definitely a pitfall you need to be mindful of. Additional concern is that training the data on which the AI is being based may be the subject of intellectual property rights. So, for example, there have been some high-profile lawsuits by online content owners contending that misappropriation of their intellectual property. Think about news outlets, universities, and the like, right? If people own the property, the intellectual property, you can't just use it without their permission. So this is definitely another pitfall. Another pitfall is data privacy violations from AI usage, such as from the unauthorized use of biometric data. This can carry very high penalties and reputational damage. Cyber risk is also intensifying as AI augments the threat landscape with new opportunities to extract or manipulate data and compromise systems. Similarly, systemic risk is possible when AI tools are related. So if multiple companies are using the same AI-related tools through a common data set or an algorithm, a failure in the system could be multiplied across different companies and financial markets, thus multiplying the effect in potential litigation that's possible. Companies that exaggerate their involvement with and use of AI could also be accused of AI washing. If their claims do not stack up, that could potentially lead to securities class action lawsuits and enforcement actions. So basically, if you're saying you use AI in a certain way, and it turns out that you're not, or that the AI will benefit your business in a certain way, and it turns out that it won't. So we've seen at least 6 enforcement actions in the US by the SEC against companies that overstate their AI capabilities. In the US, the Federal Trade Commission has expressed its intent to crack down on deceptive AI claims and schemes. Under its Operation AI Comply initiative, the agency has announced 5 law enforcement actions against operations that use AI to hype or sell AI technology that can be used in deceptive and unfair ways that harm consumers. However, this is not only a North American issue for sure. A class action lawsuit was also recently filed against an AI and robotics company headquartered in China. This included allegations that it overstated its AI capabilities. One thing's for sure is that nobody has a crystal ball, but we definitely expect to see more issues relating to AI and AI washing around the globe in the future. Next slide, slide 19. So, with AI being here to stay and the potential and it being a potential springboard for efficiency, profitability, and other benefits, a company's board must balance prudent risk management against these potential benefits. AI risk and strategy need to be board-level considerations. Boards must understand the AI use cases, the potential benefits of the AI, and set the risk appetite, ensuring that risk mitigation for AI is in place at every turn. Seeking outside advice to help with understanding AI, navigating regulatory and regulations, and properly disclosing how the company is using AI is strongly recommended. Compliance oversight should include existing compliance obligations on things like privacy, cybersecurity, discrimination, and IP, while monitoring and reporting should be set up with clear reporting lines and metrics. From an underwriting standpoint, as I said earlier, we're really at the very early stages of AI and what it means. So at this point, as underwriters, we're asking a lot of questions. We want to know how an insured is using and approaching AI, what AI means for the success of their business, and how they are monitoring the marketing and disclosing of how they're using AI to its shareholders. Like I said, we're definitely in the information gathering stage of this new technology, so getting educated on this issue and these issues is paramount for underwriters and for insurance carriers. One big caveat, while it's important not to overstate AI capabilities, D&Os cannot afford to ignore the opportunities AI presents to their businesses either. So you don't want to overstate it, but you also can't ignore it. And doing so can be seen as being unresponsive to a critical new technology. And even litigation can arise from the company not using AI as well. The next slide, please. Oh, I think you're one ahead of me. You're a couple ahead of me. It's slide 20, please. Thank you. One more back, I think. There you go. So, given the extent and reach of AI and what it could mean to businesses, the global economy, and advancement, it is not a surprise that governments around the world are enacting regulation around this topic. Potential for fines, penalties, and litigation is real and should not be ignored. For example, the European Union's Artificial Intelligence Act came into force in August of 2024. It's the world's first comprehensive AI regulation. The law addresses not only the technical aspects of AI safety, but also ethical and societal implications, and the noncompliance could incur significant and material fines. In the US, there's no overarching regulation of AI yet on a federal level. However, some states have started to jump in and regulate it on their own. For example, Colorado was the first state to enact a comprehensive AI law, effective starting in February of 2026. This law requires developers of high-risk AI systems to use reasonable care to protect consumers from algorithmic discrimination. A lot of this we talk about has the ability to discriminate against people if the AI leaves some people out. And so there's a lot of regulation starting to think about how the discrimination against certain classes of individuals might be impacted. So Colorado is on the forefront of that. Similarly, in California, they passed legislation covering transparency, disinformation, intellectual property, consumer protection, and healthcare. China, the National Information Security Standardization Technical Committee, released the first version of an AI safety governance framework in September of 2024. This framework outlines a set of principles addressing AI governance, safety, ethics, risks, and mitigation. So you can see countries around the world are starting to put together frameworks for addressing AI. I think we'll see a lot more of that in the future. You'll see it on state levels here in the US. I think at some point you'll see it on a federal level here in the US, and you'll see it being promulgated around the world by governments that are interested in protecting their citizens and their businesses from the effects of artificial intelligence. So as you can see, AI is real and has immense potential. Businesses could really benefit from some of the things that AI can bring to them. But we are truly at the very beginning of what is likely to be a long journey. And companies should be smart and start preparing now to spend the time to put in place solid frameworks around the use of AI for now and into the future. So if you could go to the next slide, and I'll talk a little bit about market dynamics, and then we'll go to Q&A. Great, thank you. So what's going on in the D&O market? Broadly speaking, on a global basis, the market for D&O remains competitive. Supply continues to outstrip demand, putting pressure on pricing. Pricing and self-insured retentions and deductibles have come under pressure for sure, but remain above the historic lows of the last extended soft market. We are seeing more business from around the world making its way to the wholesale market in London. This is putting pressure on the local markets, and it's impacting pricing and retentions in those local markets as more business makes its way to the London wholesale market. Although claims frequencies have been down the last few years, in the US, we are seeing the number of security class actions creep back up. And in 2024, we'll see an increase over the prior few years. And it's expected to continue to outpace that for the remainder of this year. Additionally, focus on corporate conduct is intensifying around the world, which means that the potential for companies to face regulatory scrutiny, litigation, fines, and penalties remains high. We have seen little change, however, in the insurance buying behavior of our insureds as a result of these market conditions. Once in a while, we'll see some insureds purchasing additional limits with the cost savings they're obtaining through rate decreases, but way more often than not, we're seeing them simply renewing their towers with the existing structures that they have. In 2025, given the geopolitical factors, the broader economic conditions, there is a potential that we see a stronger stock market in 2025 and a stronger, broader economic conditions as well. These phenomenon would potentially enhance the number of M&A deals that occur and the number of IPOs that will exist around the world. Should that be the case, there would be more opportunities for insurers to write true new business if this activity picks up, thus growing the overall premium pool from 2024 into 2025. As you can see, the D&O market for insurance is very fast-paced and dynamic, and there are a lot of moving pieces that will dictate how 2025 will play out. As I indicated earlier, we don't have a crystal ball, but there's certainly a lot of things that we're looking at and monitoring, and sharing with our insureds, sharing with our broker partners, and sharing internally. So at this time, I want to thank you all for your time listening to us go over the D&O report for 2024. In the few minutes we have left, we're happy to take your questions. You can scan the QR code here on the slide, and then we'll do our best to answer as many of these questions as possible. Thank you.
We can see some questions already come through. Do we want to take the top one there? Do you expect an increase in borrowings, capital raising, stock listings in 2025? And does this present a concern from underwriting D&O? Do you want to take that, Hannah?
Or Jarrod?
Or Jarrod?
I was gonna say Jarrod,
Sure.
sorry.
Well, either way. I think it's probably a little too early to tell. I think as we see interest rates sort of moderating around the world, you will see some capital raising and borrowings increasing. They're still at pretty elevated levels from the last few years, though. And so, I think some companies may take a wait and see approach to see what the interest rate environment will look like. I think companies across the globe, borrow and raise capital to help foster their business. And as long as they're doing it in a reasonable way and in a way that they're not necessarily forced to do it given their conditions or given the economic conditions that they're faced with, I don't know that it's necessarily a concern from an underwriting perspective. I think when you start seeing companies raise capital that they don't need, or companies that are forced to raise capital because of how they are, obviously that then becomes a concern.
Okay. Are you observing inflationary impacts on open class actions claims that will affect the bottom line? Did you want to take that, Dan?
I think the actual potential revival in IPO activity might be more relevant. I think
Okay.
Inflation in D&O world on class action is not the same as we might see in other lines of business. But I think the question about the potential for revival in IPO activity, do we see that potential? I think we do. I think that the recent Trump administration that we see could give rise to M&A. There often is an uptick in M&A activity after a change such as that. What the impact could have on the D&O insurance market, well, it's something that Jarrod touched on earlier on. It will introduce something that we've probably not seen a ton of lately, and that is potential new business. However, we just got to hope that as a market we keep discipline, because we've all been waiting for this new business, and so let's hope that not everybody climbs over themselves to write that, because we know certainly in the US the exposures that come with IPO. So yes, I see the potential. I think we see the potential for a revival. How long that will be for, we're not sure, but 25 could start seeing that uptick. And as I say, it will introduce that new business that we haven't seen for some time in the D&O insurance market.
Thanks, Dan.
Jacinda, on that inflationary impact, I think we do see some inflationary impact. Certainly not like the nuclear verdicts that we see in other parts of our of the insurance business. But we are seeing the value of claims go up. In terms of settlement values. We're also just seeing the cost to get to a motion to dismiss increase. As we get further and further out in years. I mean, the law firms, it's what the hourly rate for a partner at a law firm in the U.S. and around the globe continues to increase. So just that value of getting to that motion to dismiss has gone up, as well as some degree of inflationary pressure, and just in terms of security class action and derivative settlements on the upswing.
And maybe Hannah, you can take this one related to London. What are the main reasons for flow of business to London market?
Yeah, I think we're seeing a flow to the London markets for various reasons. I think some of it is the facilitation, the facilities that brokers have set up, the kind of automatic follow facilities that are established here in London. And if you're a multinational and you need to have that ease of coverage, I think, we're starting to see that pick up, whereas the markets were a little tighter and more restrictive throughout the remediation. Have now loosened back up. There's ample capacity available. So we're starting to see it's really some of that business that had left the London market also during that remediation time is starting to come back into London. Maybe programs that had moved to their local markets, particularly those again that are multinational, are starting to make their way back to London. They want to have London capacity involved and that London licensing involved. So there's a few more reasons other than just price driven issues coming through, but yeah, we are starting to see a pickup, and particularly international business coming in.
Right, thank you, Hannah. Jarrod, do you want to answer the second one? Do you see need to include affirmative AI coverage in the near future?
Yeah, I'm not sure that we need specific AI coverage. If it's a securities class action, obviously, depending on the specifics of that individual policy, it's likely covered if it's against the directors and officers or if it's a derivative claim. So I don't know that we need to see affirmative AI coverage. Like I said earlier, I think it's important that we monitor this, and if something changes, that would change the way that that AI is being claimed or litigated. I think we would have to consider it at that point. But I think when we talk about a standard D&O policy that covers, the entity for securities claims and the individuals, I'm not sure that we need to see specific AI coverage brought in. I think it's built into the broad forms. I don't know, Dan or Hannah or Jacinda, if you have anything to add to that one.
No, nothing to add from me.
No, I would agree with you. I think unlike what we saw when we had the inference of affirmative cyber, the D&O coverage is meant to pick up a multitude of exposure. So I don't see the need for that in the future on the D&O form.
Thank you. What trends do you see for 2025 and 2026 for international programs and partnership with captives? Is there a push for further admitted programs, changes in retentions, and limit for multinational companies? So based on what I've been reading in the news, there are more territories that are opening up the possibility for captive arrangements. So I would expect that trend to grow. There'll be more of a push for that. We certainly have the capability at Allianz. We have a team that handles that, so I can see support in that area. I think all of the trends that were mentioned earlier in the presentation around regulatory compliance complexities, we're going to need more further admitted programs. We're going to have to pay attention to whether or not our customers are properly protected. And so, yes, I think we're going to see expansion in this space. Does anyone have anything to add to that?
I guess that nailed it.
When it comes to captives, you've always had that sort of side A element. So I think there'll always be there could be captive involvement on the B and the C side for sure, but I think we always have that sort of unique issue in the D&O world of the side A non-indemnifiable loss aspect, in which case I could see that the captive has a certain involvement, but not a full involvement in the D&O world.
Jarrod, do you want to add to that?
Nope, I think that makes sense. Thank you.
The next one, do you expect the recent trend for rising greenwashing claims to continue, particularly in the US? I can take this one as well. So I covered this early in the presentation. The short answer I'd say is yes. I think it depends on who our client's customer base is and what they're trying to serve. So if you have ESG inclined customer base, there may be a potential for greenwashing exposures. We also see on the opposite end of the spectrum, green hushing, where our clients are hiding their ESG initiatives and fear of anti-ESG kind of behavior against their organization. I think this is a really complex issue. I mentioned the case with Vanguard and State Street earlier. We're seeing a lot of movement in the ESG space in general, so it won't be limited to greenwashing, but I do think this is a high area of risk for D&Os in general. Next question, how many claims activity do you see in EMEA compared to the USA? I don't know if you want to take this down.
I don't mind taking that. I mean, yeah, I think there's a perception that all the claims are in the US because of the class action system that they have and the legal framework. But actually, we shouldn't underestimate the claims activity that we see across continental Europe, especially in territories where IVI type claims are common. I think it's fair to say globally over the last few years, claims activity has probably been down compared to some historic peaks. We know that doesn't last, and we're starting to see in the US that the class action stats are creeping back up again. And to Hannah's presentation, when you have the whole insolvency backdrop, then that can always give rise to D&O notifications regardless of your territory. So I think the claims activity comparison, it probably the severity and possibly frequency it would be higher in the US, but I don't think we underestimate the the frequency and severity that we see across other parts of EMEA.
Yeah, and I would just add that and there's also some cases going through the court system, particularly in the UK right now, that we're watching quite closely that could have impact to collective actions here. So there's a lot of movement happening that could give rise to claim activity.
Thank you both. Jarrod, maybe you want to take this next one. Are there any expectations that the Trump administration may create a more business-friendly environment and possibly reduce the impact of plaintiff-friendly courts and adverse regulatory environment? Sure.
Yeah, definitely. So generally speaking, a more Republican government believes in less regulation. And so with less regulation becomes a more business-friendly environment. I think there's also the potential for some litigation, additional litigation reform under a more Republican government. So, from that perspective, I do think that it will be a more business-friendly environment, which is also when we were talking before about IPOs and M&A sort of being on the uptick. A lot of that comes from the same place. So, without getting too political, I do think that the change in administration coming in January will, generally speaking, have a positive impact on the overall economy. And as a result, you'll see businesses thrive a little bit more. How long that will last, how long it will take for that to come into effect, that's obviously a lot harder of a question and really an impossible question to answer.
Thank you, Jarrod. It looks like the next question is directed toward you as well. Given you've covered AI risks, how do you foresee AI adoption opportunities in the D&O space?
So, I think AI adoption is ripe for so many businesses, and insurance is definitely on that list. And so we are already starting to use AI in our submission intake. We're starting to use it in our sort of initial underwriting. It's more in the test phase at this point than it is in full use, but we are absolutely adapting and adopting it at this point. And I think its implications for the D&O space are material. I think the way we will conduct business is going to be will benefit from the adoption of AI in our space. Again, I think we're just so early in this process. I think the first steps will be probably minor in terms of how much it impacts us, but I think over time you'll see, and I'm talking in the market. You'll see underwriting premised on AI and things like that. Again, caution is the inputs are important, right? Garbage in, garbage out. So I think the testing of that becomes super important and a key focus and something that any company, including insurance companies, needs to focus on when thinking about adaptation.
Thanks, Jarrod. Next question. What activity are we seeing with regards to claims frequency and severity? How does this compare to previous years? Do you want to take that one, Hannah?
Well, I would say, as Dan mentioned actually earlier, we're starting to see securities class actions back up to more normalized levels. And we had some peaks, but now we're starting to see them back at what we would say is kind of those more normalized levels. The difference is that we are seeing costs are rising on those. So defense costs are up, settlement values are up. So if the numbers of claims are the same, if costs are up on those numbers. So it does seem like we have some areas of concern there. I would say also that, we're starting to see, as I mentioned before, some movement in the UK that may lend itself to some increase in claims frequency and severity that we're watching pretty closely, depending on what happens in the court system. So, so it's not just what happened before, where we had some oddities in some of the years. It's also what we anticipate to come ahead.
Yeah, the only thing I would add there is we're seeing a lot of claims that we didn't see in past years, right? So the greenwashing claims have been a couple years now, but that we talked about that a minute ago is on the upswing. AI washing we talked about earlier, that's on the upswing. Anytime you have new regulation, like we were talking about earlier, that can add potential for additional litigation. So excuse me, you definitely see potential for claims to continue to have frequency and severity.
Thanks, Jarrod. I'll take the next one. Do you see a trend with smaller businesses requiring an international insurance program, especially with regards to the UK post-Brexit? So I think for Allianz, this is a unique question because post-Brexit, we still have access to the FOS policy mechanism, which in general covers the bulk of the exposure with UK-based risks through our double hatting mechanism through our home office in Germany. But just to speak to the wider trend of more requests for international programs, I'd say I am seeing this. I think insureds are becoming more savvy in terms of international exposures. I think with increased regulation, insureds are more cautious about being locally compliant. They want to see claims paid locally. They understand the limitations around FINC or BSL. So yes, I do see more appetite, I'd say, for international programs across all segments. Next question. Could you please share some real D&O claims occurred on an anonymous basis? Does anything come to mind for you, Jarrod or Hannah?
You know, I think some of the things we've seen, and a couple of years ago we were calling this a new phenomenon, but I never viewed it as one, was the event-driven litigation. So litigation that was premised on something occurring, usually something bad occurring, whether it was a building falling down, whether it was some sort of accident, whether it was some sort of political event, whether it was COVID, whether it was some other sort of event-driven matter. We started, I think those things were always happening, but we sort of put a name on it a couple of years ago. And so, when a company has an event, that's a real potential time for litigation. A lot of what we're seeing is just traditional stock drop claims, right? So again, that follows on from the event-driven litigation. The company has an event, the stock price falls, there's a lawsuit. We are seeing less, and in the US, this was a big phenomenon a few years back in terms of the merger objection or M&A related claims. That's abated some. I think the insurance industry and brokers and clients did a good job of dealing with that through retention, because that was really never the intention for D&O insurance to cover that type of claim. And then, we'll see sort of the traditional claims, from a D&O perspective. We saw a whole bunch of claims related to diversity and companies making comments about diversity and then not living up to those. Those go under kind of the greenwashing type claim, although those are more environmental. This is more diversity. So I think those are the main areas where we're seeing claims, and we're seeing a lot in the U.S. a lot of derivative follow-on cases that come after or with security claims as well. I think we answered the next one, right?
I was going to add.
I was just going to add too, is I kind of touched on it briefly during the insolvency piece, are those company disclosures. So what a lot of the traditional cases that we see are around what companies are disclosing, whether it's their decarbonization initiatives, whether it's their the reliance on certain customers or reliance in certain segmentations, and termination of any sort of relationships. There's anything that a DRO, anything is being disclosed within their public filings is up for inspection, and we see a lot of claims around what is being disclosed in those public filings.
Thanks, Hannah. Jarrod, maybe you can take this one. Why should a funder jump on a case without merits? This is referring to litigation funding.
Yep. I don't think generally they would, right? I mean, it's an investment, and you're not going to kind of jump into an investment that doesn't have merit. So I think you're pointing to the point one on the first slide, which is, it's held by some as widening access to justice. I think that's where that justice has merit, right? So I don't think you're going to see meritless or cases without a lot of merit being jumped on by litigation funders, right? It's the investors in those litigation funders are expecting returns. It's an asset class. And so you're not going to make an investment in something you don't expect a return.
Thanks, Jarrod. Thank you for the compliment, Gune. I'm sorry if I'm pronouncing your name wrong. But moving on to the next question from Andrea. Maybe, Hannah, you might take this one. Considering a rising demand for the company cover for investigations cost in EMEA, will you offer this enhancement to large cap companies?
Yeah, I would say actually this is just an active coverage that's currently being provided. So there's really not any change there, unless I'm misunderstanding this. But yeah, this is part of coverage currently.
And maybe, Jarrod, you want to take the last one? Or no, this is a London market question, so maybe Hannah. Wholesale carriers in the London market have increased the competition in the overseas markets. Do we expect this trend to continue through 2025? What, if any, are the factors that could lead to reversal of this trend?
I think we already saw the reversal of the trend during the remediation in the London market, when we saw the capacity shrink quite substantially. And a lot of those companies, as I mentioned previously, they left the London market, they went back to their local markets. I think what we're seeing now are a return of some of those companies back into the London market. Those that want to have split capacity maybe in their local markets and utilize London market facilities. As I mentioned, maybe perhaps they want to utilize Lloyd's facilities for licensing because they're multinational. I mean, there's a myriad of things here, that are causing this increased competition in the London market. I wouldn't anticipate any material change to that in 2025. But as I said, I think it just depends on, how the D&O market performs at large.
Thank you, Hannah. And I think that closes our presentation today. Thank you all for joining. This was great. I learned a few things as well, so I hope you learned a lot. I believe we're going to share this report and our slides tomorrow. I think pay attention on LinkedIn and you'll probably find a link to that. Otherwise, thank you again for attending and take care.
Thank you, everybody. Appreciate the time.